Hey everybody, good afternoon. How we doing out there? This is Doc Severson, and I've got Dave Lukas here with 12-Minute Trading. Today is Monday, the 13th of November, and we have a little bit of a rally on our hands after the last couple of weeks. Kind of amazing here. 2 weeks ago we were sitting there thinking like, wow, is this thing going to fall off the cliff? And, is the bear back? That was the big question 2 weeks ago. And now it's, wow, what happened? So, actually we've rallied faster to the upside than we sold off on the last move. Yep. So this is in some ways you'd have to look at this as being very bullish. The second thing I'm thinking is that we all know what happened on Friday afternoon. Moody's waits until the market shuts down, and then they go ahead and they downgrade the United States again. And, everybody over the weekend's like, oh, no, here we go again. And this morning, it's a big nothing burger, nothing. So markets are flat right now, as flat as they can be, waiting on tomorrow's CPI. So, Dave, what are you seeing out there these days?
Every dip is being bought. That's what I'm seeing out there. I'll tell you what, when you pull up the charts, it'll be glaring, but the gaps in these charts from this move up over the last week and a half essentially is insane. I have to think that at least the 4,300, 4,340 gap is going to get filled at some point here. It could come tomorrow off of CPE or CPI. For the rest of the week, we'll see what happens. You got PPI on Wednesday. You got 20 Fed speakers enough, because I guess 22 wasn't enough, right? So you've got that this week, and then you got retail earnings too this week, and retail earnings obviously will show health of the consumer as well. So there's that. The 10-year is ticking up a little bit. I think the key to this whole thing right now is rates. Honestly, I think if rates go back up to that 5% area, markets are going to sell off. If they stay low, markets can continue higher. I think rates are really driving this, but CPI will affect rates. CPI will affect the Fed. The Fed speakers have all been hawkish. Powell was hawkish last week. In fact, the market, the one day it sold off some, even though it gained that and more the next day, was on Powell's hawkishness, right? So I think we've gone pretty far, pretty fast. My energies are exhausted on my chart. Typically, we would see a pullback, but as I told my students this weekend, the market will pull back when it pulls back. It'll keep going higher as much as it wants to keep going higher, right? Price is king here, and price right now is showing, continuing the upside. Look at this morning's dip. Within 15, 20 minutes, that dip was started to get a floor in it and bought back up. So that's what we're seeing. That's what the market's telling us right now until it's not. And so that's what we're doing. That's what we're watching.
Yeah, here is I'm showing a picture of this morning's price action. So we actually gapped down, and then we ended up just kind of grinding higher and filling that gap. And right now we are not far off of the highs of the day. So looking at looking at the actual, there we go. Looking at the S&P for this, what Dave was talking about here is, if I look at this chart, this is a monthly, weekly, and a daily chart. If we kind of focus in on the daily chart for a second here, you can see today's price action. We're right back where we closed on Friday. Friday was a surprisingly bullish day. And that's after going down almost 11%. So we had an almost 11% from tip to tail drop, which is, this is almost a textbook correction in the middle of a bull market, right? So this is very similar, actually, if you look at this, very similar to what we went through back here in the fall of 2020. So after we bottomed out after the pandemic, ripping higher. And just when it seemed like, that everybody was like, okay, I'm in, right? I'm in. And we got a back-to-back 10% double dip drop here for the months of September and October, which threw out a lot of people. So all the pikers got thrown off the board, and then they missed out on this move here. So are we going to see the same thing happen here? I'll tell you what, there's some logic for that right now, Dave, just because of the fact that there's nobody on board. Nobody is bullish right now. Everybody is still bearish, and everybody's still buying put options thinking this thing is going to rip to the downside.
Yeah, there's been follow on for sure at this point. That's one thing that we've seen that's kept this. That's why these dips are bought, right? People are like, oh, I missed it. I'm getting in. At any dip I can get in, I'm getting into it, right? That'll end though. You'll get to a point where people have bought and everybody's bought in, and then that's where you get the next move down, really. So I think there's a case for 44.50 maybe even this week. There's a case for that 4,300. I think it's all going to depend on the numbers over the next couple of days and what the sentiment coming out of that is. You got speakers that if the CPI, and I think the thing to watch with CPI is core CPI. The headline number, not so much core, is I think they're saying 4.1. So I think that's the number to really watch over the next day or so. But we'll see what happens to retail sales. I think like the Home Depots of the world, the Targets of the world, that sort of thing. If they're slowing down, that's going to show something else there. I think Walmart's going to crush it again. I think Walmart, a lot of people are trading down to Walmart. So I think Walmart's going to do all right. And that's kind of where we're at. And it's funny because we've been in kind of that, bad news is good news, right? Good news is bad news, mantra for a while. I think that's going to shift as we start to get into next year. This is that time of year where we typically see this type of move that we just had, right? We see this 7 to 10% move in the charts. Now, did we just get it all done in just the span of a week and a half, and we're just going to waffle around in this area for a little while? That's possible, right? But a lot of time you'll see the back half of November into early December continue that run, and then things start to fall apart a little bit middle of December. We saw that, I think you and I kind of called that last year, when we saw the middle of December kind of bottom hit, and then it kind of went from there. I think the Santa Claus rally timeframe is the December 22nd is when it's supposed to start this year. Mm-hmm. And then you get into January and then things fall apart. And that's kind of how the thing goes. So I could see us, if we get any move down, if we do get down, 4,300 to 4,340 and fill that one gap, I think that's very short-lived. Maybe you get it over a few days, and then we're rocking back higher again, and everybody that missed out buys in on that dip, and then just that kicks off this next swing higher up in these charts and takes us up to maybe the highs of the year. Before we see anything happen at that point. We got weekly charts that are fully charged. We're right back fully charged again. They started to release and then turned around, and they never fully released. So, we can go the rest of the year off those things.
So for those of you that have just joined us here, so we did, even though we forgot to email today, there are a few folks live
Thank you guys.
Yeah, so you guys are YouTube subscribers, which is always a good thing, right? If you're a YouTube subscriber, every time we do a live stream like this, you're notified of this. So especially if you hit that little alert bell. So subscribe, hit the alert bell, and then you're notified when we end up yakking like this. So thank you very much for doing that. If you guys that are live have any questions, or if you're watching this on a replay, which is probably most of you, if there's a question that you'd like to pose for us for next week's session, I think we'll do one. Yeah, I think we're good for next week, at least the beginning of the week. The end of the week, not so much. But let us know, and we'll certainly do that. Now, as it relates to these charts, here is something I learned a while back. One of my mentors, I learned price action from this. And once you learn price action, all of a sudden, everything gets to be a lot easier. At first, it was like, hey, what do you make of all this? Where's everything going? Well, first of all, you have to start from the top down. So if you start at the monthly chart on the left-hand side here, now notice what's happening here. Everything here is a series of higher lows. Even though this was a lower low, that was so brief. Everything since that point has been higher highs and higher lows. Even through last year's bear market, that's a higher low still. Mm-hmm. It didn't go all the way back down to 2,200. It's still a higher low. Now, here's the thing. This is a lower high. And a lower high could be the beginning of a reversal. And so we're going to put a big question mark over here on the monthly chart, because we don't have yet a higher high. And so
technically we're still in the bear market.
well, we're in a sideways market on the monthly chart. We're in an undetermined trend. I wouldn't say we're still in a we're no longer in a cyclical bear on the monthly chart until we start making lower highs and lower lows. So we started this by making a higher high on the monthly chart. We have a higher low. To complete this, though, you've got to have a higher high above 4,600. So we don't have that yet. So until we get above 4,600, this one's going to have a big question mark on it. And worst case scenario from this, and I almost hesitate to draw this, would be is if we fail at this point and then start trading underneath 4,100, this would show a potential change in polarity and makes this whole thing, this is almost an annual chart pattern. So if we fail under 4,100, this could come very, very quickly like that. I don't think that's going to happen. However, I do owe it to myself and to you guys out there to draw this out, to say this is a possibility. And I think this is something that you've got to do on a weekly basis. You've got to go over the possibilities of where the charts could go so you don't fall victim to this cognitive bias that most retail traders think. Because most retail traders are just going to see one direction, which is the way that they want it to go, and they're going to block out everything else. Now, when we go out to the weekly chart in the middle, we've got a whole different picture here. We have a downtrend. This is a downtrend on the weekly chart. However, something interesting just happened because you can see it in more detail here. This is a weekly downtrend. So it even shows up on the daily chart, but we have just made a higher high over here. So this is step one of the process of changing this into an uptrend. And so, like Dave was saying, that maybe we're going to get some kind of pulled back to 4,300 or 4,350, something like that, right? So either way, the odds have increased immensely since the fact that we made a higher high up here, that any kind of a drop from here should create a lower high or a higher low, and then from there, you'd hope that you'd see a higher high, and then things start to pull up. Right, so this is why we use multiple time frames, because we're able to break apart the chart into different puzzle pieces, and we can see, like this thing over here, this monolithic huge chart, it does not change very quickly, but this gives us the overall context of what's going on. And then we can pass this down to the weekly chart to say, okay, we're in a downtrend, but step one of the reversal has started, so that's good. So that's, if you hear us being somewhat positive or optimistic, that's because the weekly chart, which is a lot more powerful than the daily chart, the weekly chart has started to make that reversal process. And this is the time of year when we can see that kind of thing. And now we have to look
at the next few weeks into December. You have to err to the upside. Just, again, if we do get a pullback, that's your one probable chance. I think it gets bought up really fast, but I think the data's tomorrow's going to have that big effect on it. And that'll be kind of set the tone for the rest of the week on that CPI, especially that core CPI. And then it'll be how the Fed speakers can be hawkish at this point, but the data is going to overrule them. If the data comes in lower, it just gives the markets an excuse to say, okay, the Fed's going to continue with pausing and be done. And so that's just where we're at. Whether that's true in the end or not, right? That's how markets are going to approach the next few weeks.
We got a question that just came in live from Brewhead. I love that name. Okay. Hey guys, about gaps, any difference in probability of filling between this morning's that's below the close, but within the previous candle that's below the close? Well, we've already filled today's gap. So today's gap was, we initially dropped down. So today's gap was something like, was somewhere in the vicinity of like this.
Well, he was just saying we opened below when we went below the close, or he or she was saying that we went below the close from last Friday, right? That's the previous candle because that's last Friday, and 11.3 where the gap opens completely above the previous. See how it just, he's talking about how we gapped up and up and up without coming back and filling those. See how those gaps right there? Yep.
Right.
And then this morning we gapped down below the close, right? Of where we were on Friday, but have retraced that, right? So I still, you got to look at those gaps are like, they're like targets. Like typically markets will come back and fill those gaps. They're just, it's an easy thing to go see and get, but sometimes it can take a long time to fill a gap. Like, I mean, the QQQ had a gap from June around 240 that it took all the way to this fall to where it just got back there before this move up, right? To where it came down right to it. Like it was like 243, I think we got down to. That was the closest to filling that gap, but it took like 3-4 months to come back and fill that gap. And that was on the daily chart. So like, that's the thing, that just because there is a gap doesn't mean it needs to get filled like anytime soon. I think that's the thing you have to be wary of.
Here's a gap from October of 22, from a year ago.
Yeah.
That crazy reversal day that we had on that really bad CPI print where we gapped way down and then ended up closing much higher. So that gap is still out there and it's not been filled. We have gaps from the beginning of, or the end of 2020 and 2021. You know, we've got gaps like that. So these are still active gaps that are out there.
Yeah.
Just because there's a gap doesn't mean it has to be filled, but it does become a target. It's the best analogy that I've heard is you're out there in the Sahara Desert and you're kind of cruising around in the
water.
You're walking around in the Sahara Desert and all you can see around you is sand. You can't see a thing, right? So it's, obviously you're thirsty, but all of a sudden you notice something in the distance. It's a little red flag sticking out of the sand. Well, you're going to go walk out there and see what this whole red flag is, right? You're not going to, it's going to bug you. You're going to focus all your attention on that red flag. And that's what gaps tend to become. So I always had this question, like, why do gaps have to be filled? And then there was always these, well, it's the institutionals, traders and, their friends have been left underwater and they're going to help bring them back and make them whole again, which I think is, there's nothing to that.
I think there's a lot of gaps that never get filled.
Oh, sure.
When you gap like we did a week or so ago, where it's like 1, 2, 3 in quick succession, and you go, almost parabolic straight up like we've done, bleed out the energies, especially like on the daily chart to where they're in exhaustion range, it just makes it a lot easier to come back. All it takes is one little piece of news, one thing that just, at these levels that is just not with the sentiment or the narrative. And that gives it the excuse to go back down, hit those levels. And then that's where gaps are also a great place where people buy in at, right? A lot of people that miss a move, a lot of institution guys are like, I'm not, coming into that move and it's probably one of the reasons we saw it so violently up. All the hedge funds were positioned out of the market. They had the lowest exposure that they had all year coming into that move. And that's a lot of times when the liquidity was not so much there. And that's why you saw it go crazy. It's like these low volume weeks that we will get into, like Thanksgiving next week, where you have these low volume weeks are prone to big moves. Why? Because there's not that much trading. There's not that much volume happening. And so all of a sudden, like one thing can give a big quick move in a stock or an index or something like that. That's effectively what we saw. Now we've gapped up and gone parabolic straight up. And a lot of these hedge guys missed out on that. They probably got in a little bit, but they're looking to get sold down so they can get in and then take it from there. That's why I said I would not be surprised between this week and next week to see us come back into the mid to low 4,300s. And then that is your point where it just goes on a tear for another 5 to 8% straight up again. And people will be like, no way. And that's it. That's those hedge guys all coming in and getting their positions.
No,
And then they'll sell it off.
yeah,
Take
no,
the profits.
I know you don't want to hear this, but what I've also seen from some of the stronger moves in the past is the gaps are out there and everybody just assumes that the gaps are going to get filled and the market just keeps on trucking because like I said, by Wednesday, we are going to be fully charged again across all time frames. This thing is going to be ready to go. And so I've seen this before where markets just continue to grind higher like this because what happens is the institutions like put yourself in the shoes of a fund manager who is behind the curve at the end of the year, and all of a sudden the market starts to take off. They have no choice; they have to hold their nose.
They've got to get in
and jump in, and that's what you end up seeing, especially into the fourth quarter, is you see these rallies where people are tearing their hair out because they're like, this can't be happening, or the market's overbought, or it's exhausted. They come up with all these reasons why it shouldn't, and it just keeps on trucking. And I've seen this so many times.
Going higher until it doesn't, like I told my students this weekend, right?
Yeah.
That's why price is king. And, getting that higher, reversing and going to a higher high, even though we've got other highs to eclipse, on the daily chart, that's a telltale sign. That's why I said you have to look at the next few weeks as bullish. You may get the 1 or 2 red days in there, but overall, I think we're bullish through into at least mid-December at this point.
We got a question coming in from Chalupa Man. And actually, I've got an answer to that. I have a specific... There's a gentleman out there by the name of Larry Connors who I have followed for years and years. And Larry is this, a guy from New York, and he's not a Chicago guy. It's funny because he'll play off the differences between the two. Like Chicago guys don't like technical analysis and charts. They like their options and probability. The New York guys want nothing to do with the options and probability, and they're just all about charts and about supply and demand. So it's really interesting to see the two sides play off of each other. But Larry is famous for writing books and distilling down scanning concepts into very simple, like the RSI-2 strategy. You may have heard of the RSI-2 strategy. That's his. Right, so he takes an RSI, and instead of running it at 14, he runs it down to 2. And it's something in an uptrend. If it does an RSI dip down below 5, that's a buy. And it's just simple strategies. But he's got one that's called Connor's Crash. And I'm going to see if I can find that for a Chalupa Man here. This will take me a minute. So if there's something else... Dave,
if there's any other questions, go ahead and ask them.
I got to find the my Connor's Crash, and I'll walk you through what's on the Connor's Crash, because this is a great example of when something just goes berserk. Okay, so what I'm going to do is I'm going to bring this up. I'm going to show the scan for this. And so what I'll do is I'll go through a specific watch list on here, which is, so I want to look for a close above $5. I don't want this to be on a penny stock or cheap stock. Average volume, the 21 period simple moving average of the volume is greater than, we want 1 million, at least 1 million shares. So these two things here say that we're going to look for some bigger stocks that are, have big moving. Historical volatility is greater than or equal to 0.8. So all of a sudden it's making some big moves now. And then we're going to use a specific study. The Connor's RSI is greater than or equal to 90. So the only time I see this, and I get this report based on, because I've got this set to alert when the scan results change. So I get emailed this. But the only time I see this is when something does like goes straight up like that, just completely almost does like like an island candle up here, and just goes gaps higher, and just everybody's chasing it. And those are typically for the Connors crash. Larry is typically shorting the underlying. Now, we don't necessarily advocate shorting the underlying stock. We prefer things like you, as you say, Chalupa Man, call spreads. But that would be I would say something like a call spread with a 30 delta. Give yourself a little bit of room to work with, where you're getting something like credit is about 1/3 of the spread width. I think is a good way to look at something like that. So your risk reward is not that bad. So you don't have to play that far out. But yeah, that's a good trade. But I'll use the Connors crash as a way to specifically identify those. Any other questions for us here at 12-minute trading? So again, we do these on Mondays, usually about the same time, about 2:30 in the afternoon Eastern time. And I think we're going to do one next week on Thanksgiving
Yeah,
week.
we're good for next week. We're good for right now through till the Christmas New Year's week. So we'll probably take some time off for that, but pretty much here. And I think one thing tell everybody out there, if they haven't seen it, we can drop the link in, Doc. Is you launched your zero DTE course this week, and that's I think a compilation of a lot of years of work and study and effort on how to trade daily for income. And if people are interested in finding that or seeing that, we had a special going on that ended yesterday, but I think you can probably put the link in there for them so they can grab it. At least we'll put it in there for a day or so, and they can grab that. But what is it? Almost 50, 8 course modules with 50 lessons across different strategies on how to trade zero DTE for income. So kudos to you. I know it's been really, really across our the footprint of 12-minute trading. It's been, I've been blown away by the response to it, of how many people have gotten in and already are sending, hey, I learned this already, thank you type stuff. So it's pretty awesome. So congrats to you on that, and kudos.
I'm going to give you guys 30 seconds on what I did today. So today I set up what's called an iron fly, and these are super fast. And so I was in this trade for, I want to say something like 20 minutes. And I got 2 contracts. It was $50 a contract. 2 contracts, it was $55. So that starts off with a nice base of income. And something else that I will do is things like this, like an expected move, iron condor, like so, where you're setting up the trades at 1 standard deviation of distance. And obviously this will change with the expected move, right? So as you get more volatile, you get wider trades. As you get less volatile, you get more narrow trades, but you typically have less movement. So this is what I'm using to make my income goals on a daily basis. And so that's the course is out there for, I think, a ridiculous price. So we're going to raise this up probably starting next week. And then looking forward to also including this into the daily target 100 service, probably at the beginning of the year.
In fact, you can see, look, Brewhead and Alan have already commented that they've got it, and it's they're amazed at what's in there, and they're very happy with it, right? So very, very cool stuff. If you're looking for a solution for just trading daily, being flat at the end of the day, in and out, same day, this is the definitive masterclass on how to do that. So check that out. But yeah, well, we're going to talk a little bit more, I guess just letting you guys know a little bit more. We're looking at doing some things at the beginning of the year. We always do. It's coming up. It's a ways out, but I always do my annual year in review at the beginning of the year, lessons learned, what we're taking, strategy changes, but we announce a lot of new things too. And so we're looking at some things around this daily zero DTE and stuff of how we can maybe do that together, in our services and stuff like that. So stay tuned on some of that. But if you haven't gotten the course, check it out. It's pretty awesome. Cool. I don't think there's any other questions for today. So
yeah, I think we're clear for today. So thanks everybody. Thanks for joining us, and we'll be back same bat time, same bat channel next week. Watch for the email. And from Dave and myself, thank you very much. And everybody out there, be good. Take care.
See you then. Bye, guys.